Welcome to a new video on thoughts about market from Bravisa Temple Tree. In this video, we will talk about the defensive sector and its advantages for investors. So, at first let us define what is this defensive sector against in the market. So, defensive is a segment which goes against the economic tide. So, let us say economy is going up, then defensive sector will be in the opposite side, going down or maybe holding at a tight level. If suppose economy is going down, then defensive sectors will be doing better. So, in this manner, if we take defensives, what is the opposite side? It can be called as aggressive, because this is what I make it easily spoken to myself, while in the market there are a lot of various thoughts that are spoken, like defensives they will call as staples, core sector for aggressive segment, like that they will keep calling. To keep it simple, defensive is which is against the economic cycle, and aggressive is that which does very well during the economic upcycle. So, what is this defensive? Defensive segment is a segment which continues to have its business or consumption even though the market is or economy is doing good or bad. What are those segments? First one is fast moving consumer goods, FMCG. Second is healthcare, and to some extent nowadays even technology or IT is also coming into the defensive segment. So, if these three are defensive, what are the aggressive ones, the opposite side? Businesses in chemicals, metals, cement, infrastructure, these are the segments which are pretty aggressive. You can see when I talk about these names itself, when these businesses like when cement, steel, chemicals, infrastructure do well, that is the time economy will be going through a beautiful upcycle, right. These are businesses which are consumed when people have more money to spend. You will not go and buy a house when suppose we have very less money in our very less income, that is just required for our livelihood. Only if we have little more excesses, we will go and buy a house, buy a jewelry, go for a vacation, go for a nice food outside in a luxury hotel. Otherwise, food regular requirement has to be had. That is where defensives come. Defensive is a segment where whether we like it or not, we have to have our food. So, we have to first keep aside money for food expenses, and then if there is any leftover, only then we can go for other purchases like buying a house, buying a jewelry, going out on a vacation, those kind of things. Okay. So, first thing is food. Then the next segment what I talked is healthcare. At least food we can say somehow manage with tightness, whereas when you come to healthcare, if there is a medicine requirement, there is a surgery to be made, whether we have money or not, we have to borrow and get the work done, right. If somebody is falling sick at home and if we do not have money, we have to borrow from outside to ensure that that person comes out of the hospital safe alive. So, these are segments which will be going through a consumption immaterial of whether the economy is doing good or bad. So, obviously, the businesses will have some margins on their profits, margins or profits on their businesses. That kind of continues to be the same in the FMCG and healthcare business. So, now let us talk about the IT sector, why it is called the defensive. Very recently we have an example to talk about it. During COVID times, all the businesses went through a very big challenge because of online consumption. So, at that time there was an immediate need for companies to spend on their technology side of the business, whether they have money or not, they have to borrow and spend. So, this IT segment, that is technology segment, which caters to that zone of the economy where businesses require urgent need, and whether they have luxury of spending or not, they need to be doing that expense. That is where these IT businesses have an edge, and of course, the margins in IT is fairly larger compared to FMCG. So, when we talk about the aggressive segment, we already said that only when we have money we will go and purchase, like buying a house, we will not do it without having surplus money with us. Similarly, for businesses to do an expansion, like a company wants to set up a new facility, they can do it only if they have surplus funds with them or ready to borrow from the banks. When going to borrow from the banks, they should have a stream of business that is supporting them to repay the loans that they are going to take. Similarly, infrastructure, when the country has only surplus, they will do big infrastructure, otherwise nominal infrastructure spend will be going on. When the aggressive segment does well, the economy also thrives well, more money is there with the people and people also will start spending more. While economy goes into a down cycle, people will cut down on their spends. That is where this FMCG, hospitality and to some extent IT will continue to do well, and the margins, when we take the core sector, aggressive sector, the margins are going to be exponential, because when the demands are very high, we will see profits coming as a flow. Like last couple of years, between 2015 to 17 or 18, all these cement or steel companies were going through a very bad patch. Negative returns, even losses were declared, and they had already borrowed, that interest have to be serviced, lot of bad loans, NPAs, so many things happened. While now it became a beautifully conducive market when China shut down on their metals business, China shut down on their chemicals business, businesses thrived, margins expanded. I still remember one of the steel companies declaring 2,900% growth in their profits in one of the recent quarters. This can happen only in the aggressive sector, whereas in defensive sector their margins are kind of flat and consistent. In aggressive sector, when there is big flow of profit growth, there can be negativities also, there can be losses also, whereas in defensive and defensive sector like FMCG, healthcare, losses are very minimal unless bad management is there, otherwise businesses continue to give profits. Like FMCG has profits between 7 to 9%, healthcare between 8 to 10%, IT it's having between 13 to 17% margin. Of course, IT has other business also which supports them to give higher margins. That a company or segment growing at 7%, it will double in 10 years time, whereas for aggressive businesses, if it can double in 1 year also if the profits are very great, but that is for one of cases. So now when the whole world is going through a challenge due to war, interest rate hikes, commodity prices are going up, that is where we saw a correction in the market in the last 2 to 3 months. Now in the last week, if you see, the defensives have been doing extremely well. In our last week's Infra video also, which is there in the YouTube channel, you can access it through our discussion group. We had talked about the short term strength that is showing up in the FMCG sector. Following that, in the last week we had almost all the top FMCG stocks like Hindustan Lever, Nestle, Britannia, Godrej CP kind of stocks giving buying opportunity. First swing trades came, and now there is trend opportunities also coming up. All these trades have been published in our channel in the Platinum group. You can join the group to access these potential trades or opportunities in the market. So why they are going up? With the commodity cycle going up, energy prices going up, all the companies are going through margin pressure, profits are going to be lower. Now Jan to March profit balance sheet, what is coming out, probably in a week or 2 weeks time, we will see profits declining. That is what already the market discounted and stocks were down. So when commodity prices going up, margins are going to be down for the aggressive sector, whereas for the FMCG healthcare businesses, their margins are going to be the same, they are not going to make any dramatic change, but that consistent numbers 7%, 10% are going to show up as higher than the numbers of the aggressive businesses, where there can be losses also. So that is why defensive sectors have started doing well. Even pharma, some of the stocks have done very good runs in the last 2 weeks. So going forward, is this going to be rising forever? No, it is not that way. If we had observed, the FMCG and pharma sectors started correcting from mid of 2021. By October 2021, Hindustan Lever was around 2,800 rupees, now it came to 2,000, sub 2,002. Nestle was somewhere around 20,000, it came to 16,000 or lower 17,000 levels. Britannia, which was around 4,000 plus, has come to 3,400 levels. There was a significant correction that came after a very beautiful peak that got formed in these FMCG stocks, even in the healthcare stocks. So this rally, what is happening is just a relief rally which will hit some resistance very soon, which can be a couple of weeks or a few months from now. Similarly, the aggressive stocks which are correcting now, that is a bull market correction in them, which can find a support and they will start going up. So very soon, the rally that is going on in the defensive and pharma sector, even in the IT is getting to the top. There can be significant correction coming up in the IT sector in the near future. While at the same time, all the aggressive stocks like cement, metals, chemicals, infrastructure, all these stocks, will bottom out and give fantastic opportunity in the coming few weeks or months. So, look forward to take those trades or opportunities in this aggressive sector, and also book profits in your defensive sector by using the opportunities that we provide in our channel. To access the opportunities, join our channel by clicking on the link given in the description. Thank you. Do have a beautiful journey as the market goes through a winding pattern in the couple of weeks to months from now.